Agnes, how are you? Agnes, how are you?
I'm good, doctor.
Can I be the host?
Yes, I've already given you the
All
host
right.
function.
Okay. Yeah, good evening, everybody.
Good evening, doctor.
All right. That's very good. I believe everybody is doing fine this evening, and we have come to this session. It is fantastic time that we have for today, and the weather in Arusha is a bit colder. So if you are based in Arusha, you can feel it is cold right here. I don't know what is happening on the other places. But in actual sense, is the season is cold season right now in Arusha. But we are enjoying with the weather. It seems to be okay. It's where mosquitoes are being disappearing. So last time I gave you the assignment, and with this assignment, what I said is you should go to the London stock market and also try to find out the financial statements that we have for common companies. Why are we doing it that way? Because we are managers. We are managers, and therefore it is important for us to know all these kind of financial statements that we have in our organizations, and they will assist us to predict the future. It's where it's the base for profitability. It is the base for us to determine the net present value is the best. So what is happening is, let me come right here. Let me come right here. I believe you did that assignment, is it, Fox? Agnes. Agnes, you did that one?
Yes, doctor.
Very good. So make sure you collect that one. Make sure you collect and you put it in one folder, then you will hand it over to me. You will hand it over to me. Okay?
Okay,
So
doctor.
everybody should submit it to you by today. They should submit it to you by today. And I should know whether they visited and they worked on or they did not work. So with us, we were talking about investment decision, if you can remember. Oh yes, let me come back right here. Let me come back with another thing right here. Oh, okay. Um, with us, we we need to use information. When it comes to investment decision, we will need to use information that are being generated to assist us to determine. Last time we talked about the cash flow. The aim of the cash flow is just to understand the available cash in the business. That's what we are looking at. Cash from operation, cash from financing, and cash from investment or investing. So that's what we will be looking at. Now, how much cash we have. As a manager, this is why we said it is important for you to examine clearly the way you could use your cash flow, and the cash flow is the base for you to predict the future operation of cash. So you will have to determine that way. And we have seen most of the time when we talk about NPV, you will have to talk about the cash flow of the investments. So how it look like when you go to the real world for banks, they will take 5 years back based on your company. They will have to read the historical 5 years back and what is your prediction 5 years back, but again, prediction. So for you, you must work out on the prediction, but the prediction is based on the historical, the past records. So that's why I say just go to London stock market. You'll find companies with different projections, historical records, not projections. Mainly, if they can project it is 1 year. The anticipated revenue to be generated, it is 1 year. But for you, because you are dealing with the project, it's beyond 1 year. You can go for 5 years. You can go for 20 years. You can go for 10 years. You can go for 25 years or 30 years, 50 years cash flow. If you are dealing with mining investments, some mining investments, they are of long-term investments, and therefore the cash flow needs to be predicted, to justify and bring about shareholders' confidence in the business. How is the future cash flow is going to be? So that's why when we do this, we do in such a way we need to know how we can use this information, how we use this information that we are going to generate. So we saw that one. Available cash in each year, you will know. So you'll have year 0, 1, 2, 3, 4, 5. But as I said, when you are submitting to the banks for the investment decision, it's about going 5 years back. They will assess your cash flow 5 years back. The same applied to the income statement. With the income statement, you can, for example, right here, the income statement, what are you aiming at? Somewhere in the content of your investment analysis, you will have to justify how much is the likelihood of the profitability. So how much is the likelihood of profitability? That one needs to be predicted by you. But again, when it comes to decision and the prediction, you will have 5 years back to determine and justify the profit. So for example, this way, you will have projected the income statement for this investment. This is for 12 years. But what income statement entails you'll have revenue or sales, and this will bring about an amount that you want, and what type of sales are you doing, and also depending on the type of investment. If you are selling, you are in a mining investments and you want to come up with a mining company, you might be able to predict. If you are coming from manufacturing, if you are coming from any factory selling clothing and so on, that's your sales. How much is that going to be? So And you might be selling other items related to the company. Be uh, offer fee, and this is part of your revenue. Tuition fee is part of your revenue. It's not necessarily to be recorded as sales, but it might be tuition fees. Revenue flows to the business. So you will have to predict, but your prediction will be based on the past 5 years that you have. That's how you will have to get the assumptions. And when you are making assumptions, you must be very clear to predict your sales so that you can be able to project, how much is the sales in year 1, year 2, year 3, year 4, year 5, year 6, year 7. So if I say, for example, right here, yes, right here, I say my sales in year 1 is maybe 1,000 1,500. And in year 2, it may be 2,000. But I will have assumptions why there is a change on these figures. And this is 2,500. Why is it changing at 500? I must have assumptions on it. I must have assumptions. Not necessarily to have constant figure changing by 500 and so on. But again, the assumptions that you'll be drawing by yourself in that specific years are very important. I said the key assumptions for you is to look at inflation. That is one of the factor, and inflation and change in prices, changes in prices of goods and services. You see, there might be some possible for higher demand for goods and services at that specific year. So you will have to put assumptions and narrate those assumptions when making decision in your investments. So what you'll have your sales figure estimated based on your any assumptions that you want to say, and of course you will have to less cost of goods sold, you see, and you will have to get a total cost of goods sold. So when you deduct, it gives you your gross profit. At the end of the day, it will give you a gross profit. When you have these figures right here, and you deduct with that one, it will give you the gross profit after deducting these expenses in here, after deducting this one right here. So we say less cost of goods sold. So for us, we are not aiming to become an accountant, but we want to manage all this. Your manager, your director. So you will have, after gross profit, you will have your operating expenses. You will have your operating expenses. And with this, you have salaries and wages, employees, benefits, payrolls, taxes, rent, utilities, repair, maintenance, insurance, travels, postage, and the others. You see, depending on the type of the investments and the training expenses, depreciation, and so on, depending on the way you will consider. But what are we looking at? We will have total operating expenses given to that specific years. But we will have to get the operating income is this one, is when we find ourselves, we have the how much is available as operating income before we deduct interest and other charges. This is when you take your total operating expenses, deduct, or of course you take your gross profit, deduct with your total operating expenses, and that will be your operating income. Now you can use that operating income to deduct with the, if you have interest and other charges. You see, at the end of the day, you will need to know if you will borrow money from banks. This is the point. You have to deduct your expenses for the business, and you will need to get the total income before taxes. Any investment must pay taxes, so you will have to ask yourself, this balance is before taxes. And taxes, remember, it is almost 30%. So you will have to take into consideration taxes. This is income tax, 30%. So you will have to charge, and then you get net income after tax. Okay? So once you get that one, we will, depending on the type of company, is that one. Some of it can go to dividends. You can get, you can share with the, you can demonstrate share as per shareholders standard and requirements. If you don't have that, is going to be the scenario for your operation. Maybe it is a private company and so on. So you can operate with that. So for that case here, what we will need to know is the cumulative income. And this is what we want to know. We have all these years. We have all these years. What is the cumulative income? So this is what you will use for the investments, especially when you talk of, sorry, this one right here. This one is very strategic to us. This information that appear in red here is very strategic for us, because it is where we can justify our net present value in relation to accumulated profit. So you will have to narrate. Based on this company, we just realized that the profit initially was this one, and this profit is expected to increase. The net profit is expected to increase, and actually it is the net profit after tax is expected to increase and reach its maximum. You'll have it, and you mention the amount, then you say that our total accumulated profit is this one for the period of 12 years. That one we can use to justify our investment. This one right here. This one right here. We can use to justify our investments. So we support the accumulated profit in relation to the net present value and say this investment, there is no way should it be rejected. And also the net present value validate the same. Of course, these will appear in your attachment. These will be part of your attachment. If you are borrowing money from financial institutions, that is how you will use this as a manager, you will use this information. Are we together, folks? Are we together? Are we together?
Yes.
Oh, very good. Very good. Very good. So that's how you will use your income statement to validate the investment during a specified period of time. And what I have said, these information are very strategic. And you will remember me when you are, of course, some of you are experienced already, so you know. And some of you, you can work out. But what we say is the income statement very expensive, very important. We are using this to show justification of our profitability of the investments that we have selected. And that's why I said it is important to a manager to understand the cash flow. It's important for a manager to understand before the cash flow, understand your revenue, understand your cost, but again, understand your profitability and revenue generating activities. Those are very important.
Excuse me, doctor.
Yes.
When do you get the net profit based on example you show us here?
Oh, very good. The net profit. You see the net profit, the operating income right here. You see the total operating expenses. Okay? Have you seen it? God grace, have you seen it?
Yes, sir.
Yes. So when you take your operating expenses deducted from gross profit, so you'll have gross profit right here, of which it is this one right here, deduct with operating expenses, it gives you the operating income. This is the operating income, of which is the operating income. We need now to deduct other expenses like if we have borrowed the money from banks, then we can deduct interest. Oh, we can, if it is expenses, it means we are borrowing money from commercial banks. Therefore, it is interest rates. We deduct it, then it will give you the total non-operating income you will have. You less. This is before tax. Okay, this is before interest, and this is before tax. This one right here. And then you'll get after tax. This is what you will have after tax. God's grace, are you okay?
Yes, yes, doctor.
All right. So for us, we are interested with this cumulative net income for the period is this one. Now here, if you have shareholders, you will again distribute among the shareholders. But how much is the profitability in the annual? This is very important for you to support your analysis with your net present values, and because these are going to be part of the attachment in your analysis to secure funding. You can secure funding. So it's a tool for manager. And some companies die, they don't survive. You find because they don't survive, the ability, they don't have investments that can demonstrate ability to generate cash and get profitability. And this is the problem that many companies are facing in Africa, and not only in Africa, it is also in Tanzania. They are having problems with that. With us, we are looking at that. Now, just again to say, apart from this is your income, you will also have your balance sheet. Let me go down right here. Let me go down here. So what is happening here? Because I told you to go and check it out. I'm just recapping. Your balance sheet for any investments you might have done, but the approach might be different. Your statement of financial position, of course, it will demonstrate your asset and your liabilities. It will demonstrate your asset and your liabilities. Your asset, your asset, and your liabilities. Now, with these are very important again. You will have your fixed asset. You will have your fixed asset, and you will have your current asset, current asset, and also you'll have owner's equity. This owner's equity, owner's equity, but again, you will have your current liabilities, Now, with this, why are we doing it? Now, you can put it horizontally if you want to project number of years. So it may appear the same, but arranged in a different format if you have so many years. But the most important thing is for you as a manager, you must be aware with what is asset and what are anticipated assets are likely to be procured in these investments for the next 50 years. So you'll have to predict that one. That capability is most important. Why? At one particular point, you will have to suggest to the company to borrow. The company someone was making noise in our classes, so I had to remove him because he forgot himself. And so I don't know what we were talking about. Hamidu, you know what we were talking about? Hamidu? Hamidu? Okay, so what's happening here is you'll have your fixed assets. You will need to identify what are the fixed assets. You see, what are the fixed assets? You'll have to identify. Just like that example I've given you, I said go and check that one. But again, you have your current assets. These are things like cash at bank, bank balances, stocks, and so on. This will be part of your current assets, but you will need to predict how much is that one going to be. Because if you cannot be able to predict it, then it means you don't know the investments. You don't know how to make investments viable and operate in a real sense. So as a manager, you need to manage. If you don't have such capability of doing it by yourself, make sure that you have people who can assist you to do, but you are the one who will be presenting in the meeting. You cannot just say, so and so present this in the meeting. You are going to be presenting, talking with bank officials when they come. They will meet you, you discuss, you will be arguing, you'll be defending. So if you don't know what are the assets that are anticipated to be generated out of these investments, it's going to be a problem. So refer your example that I said, go and download the London stock market. You'll find a lot of assets. These are the examples that you have, and you will have the current assets. You will have the owner's equity as part of liabilities, and also you will have the current liabilities if you are borrowing from banks or you are getting overdrafts. These are current liabilities. You can have long-term liabilities and short-term liabilities. These are things like the, they are short-term by nature. So your bank advances, loan advance, bank overdrafts, and others. These are liabilities that the company is obliged to pay in the coming years. So that's why they have to check that. And for the assets is also very important because they can stay fixed assets. These are the assets like they can stay for more than 1 year. And for example, you can have furniture, you can have the building, you can have your computer, you can have photocopier, you can have equipment, you can have the land, and so on. So this will be part of your fixed assets, fixed assets. But when it comes to current assets, as I have already said, you will have your debtors, you will have your cash at bank, cash at hands, you'll have your stock, and so on. So that is going to be. So the strategic point is for the manager now, for the manager. Why do we want that information? This is where we can know available assets and the ability of the company to borrow. That's very important. You can determine how the gearing ratios, the investment ratios, the profitability ratios can be defined in advance. So for anybody who want to come and invest in your company, will have to look at that company carefully and make a decision with regards to that. So with this one, that's why we use the statement of financial position. Formerly, we used to say this is your balance sheet, but people have changed now. They don't call it balance sheet. They call it a statement of financial position, and therefore it is strategic for us. So 3 things that are very strategic to us: the cash flow, because it will tell you available cash, and we have the income statement. It will tell us the annual profit, but again, it will give you the accumulated profit for the period of the investments, and therefore it is important. They go hand in hand, and the balance sheet as well. It will tell you about the investment analysis, whether it's going to be sustainable in the future or not. So you will have to check with that one for investment decision. Now, let me love this one. Let me love this one right here. The only point that you will need is that dealing with the financial institutions, it requires you to be very smart, and becoming smart in terms of projecting your cash flow is also a strategic point for you to understand. Let me say here, we also have this one right here. So there are some investments that are mutually exclusive. There are some investments that are mutually exclusive, and we call them mutual exclusive investments. The mutual exclusive investments, these are investments that we find ourselves that they cannot happen together. You have to select. They tend to compete one another, and but you have to select one investment and leave the other, and this is mutual exclusive investments. With this way, what you are looking at is you want to go for investments. We should not try to be overambitious. It is very important. We cannot, but for us, we should not try to be very ambitious because we have limited resources. So at one particular time in your offices, you will have to find you need to do a lot of things. And if you are not planning as the way is supposed to be planned, you will realize losing. So you may go to investments of which cannot pay. But there are factors that you will need to look at it. So we say here that The mutual exclusive investments is a statistical term describing two or more events in terms of investments that cannot happen simultaneously. They cannot happen together. You cannot do them together. It's used to describe a situation where occurrence of one outcome supersedes the other. So you want to go to investments. You want to go to the investments. Should we invest in mining? What type of mining is that one? Should we go and invest in gold? Should we go in and invest in graphite? Which one should we go? So you will have to compute. So for us, you can apply the net present value that can give you a proper choice with regards to the investments that you want to make. And we say this is mutually exclusive investment. So you cannot execute all these investments, all of them together. No, you'll have to set a priority. You must set a priority. Now that priority will be based on the net present value in some cases. In many cases, people prefer using the net present value to determine the mutual exclusive investments that we have to forego the other investment and run this investment. We might say we want to go for standard gauge. Now, if you are doing investment in the standard gauge, you may set a priority by saying, because we don't have much for road constructions, let us concentrate for standard gauge. That's a mutual exclusive. Now, you will check which one is profitable. Now, you'll be based on the net present value. The net present value. The higher the net present value, that is the best choice for you to do the investments, especially for mutual exclusive investments, where you find you have a lot of things to be performed, a lot of opportunities around your organizations, but you cannot be able to do investment in all. Now you must forego the other one. So you'll find the other one supersede the others. So once you say we are going with these investments, you have to forego the other one. So mutual exclusive is used to describe when two or more respective outcomes cannot occur simultaneously. And if one result is chosen, all other possible outcome cannot be true at the same time. And that is mutual exclusive investments. The mutual exclusive investments are the capital projects which compete directly each other. So we say, for example, if a manager has to make a choice strictly between undertaking other projects, for example, project X or project Y, cannot both of them concurrently, then project X and Y are said to be mutually exclusive. You may wish to do everything. No, you are limited with the time and resources and the profitability. So you have some limiting factors. And that's why you come with the mutual exclusive investment. And therefore, mutual exclusive investments, it refers to the scenario where an investor must choose between different investment options, because selecting one investment excludes the selection of another. And that is the mutual exclusive investments. What are the factors? Yes, we have some factors. We have some factors. And there are factors that determine for mutual exclusive investments. One of them is the projected returns. What are the returns? What are the risks? The returns of these investments. So you will have to check the returns. You will have to check the risks associated with the investments. The higher the risks, well, it depends. The higher the risks, then you should be knowing what is happening. The lower the risks, you should also be knowing what is happening. And should we go with this investment where it has high risks? Or should we not go with this investment that has high risks? Because we know when we go with the high risks investments, it will bring more returns to the shareholders. There will be more profit. So if that's the case, what do you want to go with it? Because you are going to get more profit. But remember, when the higher the risks, the chances for you, if events happen and change the business operation, then may find yourself not succeeding the events, and therefore it's going to be a loss to the company. And the less the risks might not be good, attractive for the business. So, of course, the trade-off between the two, it will depend with the managers themselves. There are some managers who are risk-averse. There are managers who are risk-averse. They fear to take risks. Why they fear to take risks is because they know if they take risks, if it happen in the business, the chances of their survival, it will be very minimal and almost zero returns, and the shareholders will not be able to get returns. But there are people who take risks. They know exactly that when we take risks, we maximize, we get the returns. And if we execute as per plans with other risk mitigation, then we may be able to maximize the profitability. Then we find shareholders will be getting higher profit. But if you succeed, you get a reward. You get the reward for the risks. So the manager, there are some risk takers managers. They take risks, and there are risk-averse managers. They fear to take risks, and you should also be knowing about that. The time frame. The time frame. The time frame is another factor. The time determine mutual exclusive selection of the investments. How long the duration for the payback for you to operate and succeed and meet the target. So you see, is a problem. Is a problem that will determine for mutual exclusive investment. And also, do you have enough resources, or you don't have enough resources? If you don't have enough resources, you will go to that one. Even if it has higher net present value, you'll have to go and meet the investment that you can operate within the limited resources. And that is one of the factors. Another one is market condition. Market condition determine mutual exclusive investments. The product is highly demanded, and when we look at the market itself, the target market, they demand the most. So if there is high demand, you will go and produce more, and therefore all these points will depend with the manager himself. So we may use the NPV and the IRR in terms of ranking about these investments. But what you see here, what you see here is that when we check our cash flow here, when we check our cash flow, and when we use internal rate of return, and these are investments. You have investment A and the investment B, and therefore these are the cash flow. You have year 0, year 1, year 2, year 3, year 4, year 5, you see, and these are the generated cash flow, just like the one that we have been saying, and we did in the other time when we were doing discounting. What's happening right here, you have the cash flow at year 1, year 2, year 3, year 4, year 5, and we have corresponding internal rate of return. So when you compute, you'll get, when you compute the internal rate of return for this, you get it. And also we have the investment B, of which we just realize this is the cash flow that goes along those years. And also it gives you the internal rate of return. Now, with this, which one you may use it for ranking your investments? It will depend with you. So if we have these investments, given the internal rate of return is 10%, it has given us NPV of 5,688, and this one, and the investment B has given us 5,200. So we ask ourselves, which investment should we undertake and why? God grace. God grace. Which investment? Yes. Tobias, you want to respond? Yes, welcome. Tobias. Unmute yourself, Tobias. Tobias, unmute yourself.
Yes, doctor.
Yes.
Yeah. After that analysis,
Yes.
my decision as a manager
Yes.
will be on project A, and the reason
Why?
for my choice is the NPV value is higher than on project B. And as you said that the higher the NPV, the profitable the investment. Thank
Very
you.
good. Very good, Tobias. Clap hands for Tobias. That's very good. Very good. Very good, Tobias. And God's grace. Is God grace. Why do you think Tobias has said we should go for NPV? The investment A is mutually exclusive at this time. We may undertake it because the NPV is high. Why? Why not IRR? Okay, he's silent. Amidu, yes, Amidu Ndago. Wisdora Mush. Wisdora Mush. Wisdora Mush. Wisdora Mush. Okay. Karen Michael. Karen Michael. Karen Michael. Karen Michael. Oh, I don't get, you guys, you're not responding. So there is one guy who is capable of responding in this class. Tobias. Tobias. Tobias, are you there? Tobias? Hello? 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 Anybody? Anybody? Ashim, Peter. Ashim. Ashim.
Yes, doctor.
Yes.
Yes, for me, I think as an investor or as a manager, I will choose NPV as a previous speaker have been saying, because it maximizes the wealth of the shareholders.
Okay, that's very good. But why not IRR? Just to remind you, one time we say NPV, 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 and the IRR, they are inversely related. They are inversely related. Here is the break-even point. So what you see, the higher the IRR, the lower the NPV. You can see even these results suggest, is it? You see it, Ashim. These results shows. You can see when the IRR was 25, NPV was 5,688, is it?
Yes,
But when it was 40%, the NPV was 5,200. So it's also suggesting that these are inversely related. And therefore, IRR might not be a good indicator for the investments that has more profit on it. Okay? I agree with you. That's why most of the people, most of the investors, they apply the NPV as their choice when it comes to ranking these investments, all of them together. And yeah, so thank you very much. You have good comments.
Okay, thank you, doctor.
All right, Ashim, thank you. This is what I was talking about, and I will not repeat. I have already said. That one. Okay. Now, I wanted to give you one example, but I think it is enough for here. Let me go to another part of our discussion. Okay. Let me go to another part. Okay, this part I will talk for today again. We were discussing as a manager, I was putting emphasis on the application part of it as a manager. As a manager, I said you need to be aware on how we build up cost, how we build up revenue, how we look at cost benefits, and also projections. And because you'll be using money from financial institutions, and therefore it is important for you to observe the discipline of making sure that you can justify the use of money by using papers. So you use papers, you draw it up, then you make justifications, your financial statements, your income statements, you compute, you discount your investments, then you justify with the banks. And those are the languages that you'll be talking to the loan officers, to the bank managers. There is money in this country, there is money in Tanzania, there is good money for investments. It's only that people are not serious about investment in this country. If you are serious about investments, you may do the investment that you want. A good person is the one with the skills on how to use financial institution money to run projects, and that is the desired outcome. The desired outcome. That is the desired outcome. What I was saying is the only problem that we have some managers who are not serious. They don't know on how to play around with financial institutions, and you'll find that their organizations suffer. And some cannot be able to take it up. Taking off, they cannot be able. Why? They are risk averse. They fear, and they find it's a challenge for them, and therefore there is a problem. There is a problem. What you see, we want you guys to become investors. We want you guys to interrogate with the banks. But how do you interrogate with the banks? Is it through financial projections, your NPV computations, your costs, your revenue? These simple things that we are talking about right here, checking out affordability within the interest rates and so on. These are very important for you to interrogate with the financial institutions in Tanzania. And that's why they are here. So you have a lot of opportunities, but people are not utilizing. And actually at this time, you can go for hotel constructions, for lodges constructions, for B&B constructions. You can go for tour company and so on. So there is potential. The problem that we have is many managers are not serious. They're not serious about investments. Is that okay? Hashim, is that what you think? Hashim, is that what you think? Or Tobias, is that what you think? Jessica Sungura. What is your opinion on Jessica Sungura? Jessica Sungura, what is your opinion? Jessica Sungura. Oh. Ndiamukama. 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 Oh, okay. So nobody is responding. It's okay. I wanted to make it live, but nobody is responding. Are we together in the class or are we not together? Yes, Kiruma Sweke. Kiruma Sweke, welcome. Kiruma Sweke. Kiruma Sweke. Kiruma Sweke. Kiruma Sweke.
Yes, doctor. Sorry,
Yes,
I
you
think I
want.
had a challenge with unmuting. Yeah, I think it's very true. The same. Most of investors fail to make critical analysis and negotiate around issues such as interest rate, such as projections and assumptions. So they end up either under financing projects, which later on result in failure,
Very true.
and banks sometimes do the same. They can finance a project and end up not really reaping the return on investments as they expected. So I think it's a problem on both sides. So banks have to look for better ways on assessment of risks, as well as businesses have to look for a way to negotiate around how to invest and especially partner with financial institutions. Thank you, Doctor.
You're right. I appreciate so much. It's a good contribution. It's very good, a remarkable point you are putting it up. And we have this problem, and the other managers don't have confidence even to borrow maybe 40 billion. They just leave it to other people. You know, when you leave it to other people, they will benefit from your country. But with us, we need also to benefit the same. You can borrow 2 billion, you can borrow 5 billion, you can borrow 10 billion. Because I was looking at one of the company in Malawi, that was Acacia company. They borrowed money, but again, they demonstrated the net present value given period of 75 years. So for them, they demonstrated expectations, because the future is undefined. The future is unknown. So we are just operating on probability. So if you have very good forecasts, very good papers to defend yourself, Tanzania is the best place. And that's why you managers of today, we encourage you to go and work hard to produce the best papers to secure financial requirements for your companies. And that is very important for sustainable of your country. We need you to borrow money from banks. We need you to do investments, not petty business. No, do serious investments. If it comes to farming, you should mean farming. If you talk of livestock keeping, you should mean livestock keeping. You know, you should not be messing around. You know, you borrow 50 million, you borrow 10 million, you think you are borrowing it too much. No, borrow 2 billion, borrow 20 billion, borrow 30 billion, you see. But which investments are you going to operate? That will remain to you, managers of today. That's why we are saying here that for all people, I wish if it could have been my decision, then I could say if we find some few guys who have borrowed the 10 billion, demonstrated the capability of running the investments for around the 10 billion, we can give you your certificate. We can give you a certificate. If you can borrow money from financial institutions, demonstrating the capability of running the investments, 10 billion, we will give you money. We will give you certificates you want. We'll give you the certificate we want. So that's my ambition. We should reward the people who can demonstrate competency, the hands-on, Okay. Now that's all. You must select the investments with the higher NPV, and therefore you realize maximizing the returns from the shareholders. And that's the point we are putting. Now, at this time, we talk about risk analysis and management. We are talking about risks. Any investment is characterized with risks. And with this, it is out of these risks that we need to know. We need to know how much are we going to be affected. And if it is a matter of being affected, how should we mitigate? And this is about management of risks, because we are living within the company where we find we have contractual risks. We also have operational risks. We also have environmental risks. Those are the types of risks that we know. You may find yourself, a firm can go into contractual arrangements, and once you sign the documents, it is irreversible, and therefore you should know it is a risk. Before you sign any documents, read the content and understand the content of the contractual arrangement. Because if you don't know the contractual arrangements, the details of the contract is going to be a problem. So, and you can, excuse me, you can find yourself having a problem. For example, let's say we are going to get into contracts with one of the company, maybe Chinese companies and so on. So if we get into contract with that, there are probability of loss in bid, loss bid in tender. There are probability of poor cost estimates, So you go to the actual contracting and then you have poor estimation. It's going to be a problem. And when it backfires, this one is going to be a very serious damage to the manager who's running the project or the investments. There might be delay in the payment process for that investment. So if you delay, what are the risks? It's going to be risk to the government, risks to your company. It's going to be risks to the individuals operating. You see, because you will have to pay laborers, you will have to pay wages for those people who have been employed in the projects, and therefore you need to check about those risks, and you must cover and you must mitigate. And also you can have risks in terms of operations. If one of the equipment falls down and it may knock somebody, maybe you are constructing a flat and you find it is that way, you need to be careful. During the operation, anything might happen. Even if you're constructing a flat, a stone may fall down. If people are not using helmet, then that's the business. The business is over. So you have to ensure people on site. As a manager, you have to ensure people on site and all those kind of things. So you need to know the nature of your operation by looking at the type of equipments that you are going to use in your investments. So you need also to make allowances for weather, allowances for change in water. For example, if you are working in this area of the investments, then you know what about maybe you are constructing the hotel. It is very closer to the beach, but it's risky. It's good. You get good number of people who will come and relax, and they enjoy, they get big time. But what about the tides? when the tides, what about the floods when they come, and the waves response, and the other site conditions, water catchments and so on during the construction. So you'll have to check. And also for environmental risks is the same. So there are some environmental hazards of which you need to take into consideration when evaluating about this investment. And you will have to check whether the site is contaminated or not. So you have to make the preliminary calculations on the possible outcome, possible likelihood outcome. What will be happening if we are running the investment right now for the next 30 years? So we have to predict what will be happening by 2050 in Tanzania. So what will be happening by 2050? Yes, you might not be there, I might not be there, but I will need to predict so that those people who follow behind me, they should be able to follow the plans that has been certain by the investment assessors. So as a manager, we say failure to consider risks and uncertainty will lead to firefighting. To will lead to firefighting. So as a manager, you must always consider risks in any type of investments. Any type of investment, whether it's a small size or it's bigger size, you will have to consider uncertainty and the risk associated. So you'll have a choice as a manager. Are you risk-averse manager? If you're risk-averse, you'll not be sustainable. In some projects, you need to take risks. And we are not always planning for comfortable zone. There are some zones where you know, I have tried, but I have failed. But you tried, you performed good, but you have failed to demonstrate the results. There is no problem. There is no problem. That one is good. If you plan, if you plan and consider about risks associated in your projects or investments is very important. So you can imagine that gentleman is working over there down, and he is using the timber to tilt his vehicles. So this is a shortcut. When you go in town, that's how people are doing. Rather than using a jack, this man has used a timber. It's not using a jack. Now, suppose this one tilt a little bit. If the timber tilt a little bit, this man is no more. It's gone. It's finished. He will not live. But he has applied his risks. He never calculated his risks. It will bring about a total loss about himself. He will be gone, but he's using a timber and to jack his vehicle rather than using a jack. He was supposed to use a jack. That is the only way he could survive. But it is fine. The accident never happened. But we say, generally, high risk things or investments, be careful. You must calculate. Very high risks, you must calculate. And very low risks, you must also be responsible for low risks. So it requires balance. And this balance will be determined by the managers themselves, depending on your character to survive in your position. And if your character is good, and that's why when you go to UK, you might have read some of these reports from UK. You might have read, you are not copying. I believe you are not copying because you're not just copying and pasting. What's happening is directors' salaries for UK is very high. It's very high. Monthly salary for a director might be like some of them 150 million, 200 million in a month, just in a month, 200 million in a month. Now, when they get 200 million, but they work so hard, they work so hard. They demonstrate profitability. They demonstrate the future operation. They demonstrate, they give confidence to the shareholders about their investments. It doesn't mean that they are running from risks. They take risks, and that's why you find some companies from Western countries, they are also here in Tanzania operating. So I could wish, so some of them are, buying coffee right here. They take risks. They come in the bush right here. They buy coffee. Now, if they come in the bush right here, they buy coffee, what are you expecting? What are you expecting? The expectation is they take risks and they get profit. But what about us? You go to France. You go to France. They sell our coffee, but they brand it made in France or made in UK. And ourselves, we sell raw coffee without knowing that coffee in the Western world is profitable. That's very good business. So we don't know about it. So we need managers of today will go and organize themselves. They can produce coffee right here, brand it right here in Tanzania, and sell it, the finished product, to France, to Romania, to UK, to Italy, to USA, because those countries, they don't have coffee. And they are the people who use coffee a lot. So they can make a venture. Here, we can make a venture. So we need to have a serious manager, very serious manager. We should spend our time more in doing investments. But we spend much of our time speaking about Liverpool and Manchester and other play, of which we are wasting and ruining our time. When you lose time for today, it will never come back. Tomorrow, you'll lose it forever. So you be wise on how to use your time. Use your time properly for the betterment of your country and your people. And you are the manager. You are responsible. So some of you can be risk averse. They can fear to take risks. Some of you can take risks. Take risk. So I encourage you to take risk. Even if you fail, you have tried. It doesn't matter. Yes, it will be a total loss, but you have tried. But again, take calculated risks. Your risk must be calculated. You exactly know the events that will happen. It's just like nowadays. To get married is risky. So you must calculate it properly. And that's why you find that there are some men who don't want to marry because they are risk averse. They fear. They are risk averse, they fear. And now, how long will we stay without marrying? And so on. So because there are consequences. But when you marry, there are also risks inside it. So and these are things. So risks is something that may happen or may not happen. And if it happen, may jeopardize the success of the organization or the investment itself. It is non-desirable events or the outcome. It is non-desirable, so it must be calculated. And that's why in some cases we insure. We know traveling is very expensive, we insure. We know one day you will get sick, you have national health insurance. You insure your health. So you can insure your building, you can insure your activity, you can insure. And those that you find you can go with it, let it be so, because it has been so. So it involves the process of risks as a manager. It involves risk identification and analysis. So you will need to identify what are the risks, and also risk management. And you will know how to manage those risks and how to mitigate those risks. Risks are not known, and they change with the time. So you need to update. They are manageable in the sense that the action may be taken to change their impacts. They exist only in the future tense. That's the risks. And they exist in an organization. In all organizations, there are risks. So, and that's why ourselves, we need to measure and determine risks, because risks may happen or may not happen. Even sometimes delivering things late, or things are going wrong, it's part of the risks. You see, you get loss of income, it's a risk. You need to predict loss of income. So that's why we have to look at risks. We need to look at risks. Uh, we need to look at risks carefully. And what is management part of it? So it enables you in decision making, and it's a very good practice for management. Nowadays, if you're working in a company, you have the risk champions and you have risks managers who also speak about risks. Each divisions or units will have to come up with identified risks for their operations, and they also propose the way on how risks can be improved, and so on. And also what you will see in this context, what we will say risk management is the name given to logical and systematic methods of identifying and analyzing and also treating and monitoring the risks involved in any activity. So that is the risk management process. So you'll have to identify, you'll have to treat, and so on. So it helps manager to make best use of the available resources when running it. Each division in your organization is responsible for the risk management, and this includes the finance sections and the public institutions and investment centers, where it might be for the private sector. It has to be utilized fully when running the investments. So what you will need to do, you will identify, you will establish the context and identify the risks, and you will also, once the risks identified, you analyze the risks and you evaluate the risks, and again you treat in terms of your evaluation. You will have to compute. You'll have to compute this one. You'll have to compute. But here you will have to, when you are computing, you check for probability on how is the likelihood of the risks and so on. And here it's about treating, it's about mitigating. So you'll have to produce the risk register. The risk register will need to be updated by knowing all those risks are in our projects. So there are obvious risks, and these are financial risks, and others are contractual risks, and others are resource risks, and the other just opportunity. You know, anything, and if an opportunity happen, it is also a risk. So what you will see is they will depend with the sources of the risks itself. The risks can be financial risks, interest rates, the ability for you to pay back the principal plus the interest rates. It's an issue, and you might be having some issue of fraud in your organization. How do you control fraud in your organization? Do you have control in the process? As a manager, as a director, you must have control. You must understand that these are finance. How do we control so that people do not steal from our organization? You will have to set some procedures that will assist in mitigating that one. And that is also very important to manager to know. What about if we cannot be able to demonstrate if we are not capable, we are not able to generate cash flow, what will be the risks associated to it? You cannot be able to pay the loan. You cannot be able to pay back the principal plus the interest rates. So the cash flow is very important for you to look at it. Contractual arrangement. You go into contract, you see, and you are not serious in looking at those figures indicated in the contract and the content. That will give you a big blow of your operation, and therefore you should be discouraging. Resource risks. There might be some delay. You know, you may give some individuals a tender, but they are not capable of, you know, delivering, and they may not deliver resources in time, and so on. And the ability of you to procure is also very low, and so on and so on. This will be part of your risks associated to obvious risks. What are the sources? There are so many. Risks can be internal, arising within the project or the investments. They can be external, coming out of the projects. There are others accompanied with the human factors, the competency of your people, the competency of your staff, the competency of your team that you are working with. Are they capable of preparing the report timely? Are they capable of generating the report timely or not? So what you will see is you have human factors that determine. If we take this man to go and present us in the United Nations, can he really speak and represent Tanzanians? That is also risks, the capability of the individual to represent the organization, to talk, capability of individual to write, capability of individual to deliver is also an issue that you'll find this as can be associated with the internal and so on. And some risks associated with political issues. You see how the politics can interfere. People may come, may demonstrate, and your investments may be burned out. You see, when it burned out, like last year's investors were reluctant. They never thought that people can come and burn a petrol station and so on. If we could have taken those one into analysis, then we could have said, the demonstration might come. So what we need to do is you put more security, put more cameras to detect those individuals who will be coming to burn down and so on. And political issues may change anytime, especially in Africa, where you find the political climate is not very stable. So it is a risk you must predict, depending on the duration of the investment. And you should be checking some legal consequences. You see, there are some legal consequences. And also, there are some economic and financial matters. We have already said you'll have to consider all these and technical operations and so on. And so on. So this is what I was talking in summary. So you'll be reading by yourself. There are some vocabulary when you talk of risks. There are some vocabulary cause owner, and this is person accountable for causing the possibility of a risks, and this is the cause owner. Classification, you can. This is just a matter of risk level. You can label it as high risks, medium risks, low risks, minimal risks, depending on the classification that you have. So these are risk level that you can have. And also the contingency is cost or time allowance to compensate for probability of a risk. So that's why we need to have a contingency when we are planning for the risks. It is also important that the cost that will be involved to compensate if it happened. And this is the probability. And the risky also, we have risk dependency, where risks depend on an activity, and that is risk dependency. Risk exposure, we say the risk exposure, this is the product of the financial impact and its probability of occurrence. And the risk exposure of an investment is equal to probability. We say is equal to probability of risks of occurrence multiplied by total loss if risk occur. So this is very strategic. This is very strategic. The risk exposure. So how exposure you are, you must understand the probability of risks and also the occurrence itself and the total loss that will happen. So everything you set the probability, and that's why we have to do the probability. You set the probability of occurrence for that thing, and also the impact effect of a risks are usually shown as a cost or time delay. So that's the impact. And also mitigation is action to reduce or eliminate the events for the exposure to the risks by insurance or transference of the risks. And also the probability, this is likelihood of risk occurrence. So what is the likelihood of risk occurrence? So you must develop capability to visualize the future, to see the future, and that future has no formula to determine, and we normally use a probability, and the probability is mathematically calculated. It may happen by 2%, it may happen by 4%, and so on, depending on the issues. So we also have risk budget, of which we say this is much more related to allocation of cost and schedule, held in reverse to spend in reserve to spend only with the emergency of uncertainty. This is the risk budget. Risk owner, we have already said, and the risk trigger. Risk trigger, we say an event that indicate that risks need to be reassessed. So this is the trigger. Which risk trigger is that one? So you will have, and you have risk schedule. Now, with those trigger, as I have already said, you should identify and put them in the risk register. You should estimate what are the risks trigger in your organization, and you assess the environments for the trigger that should be identified at the early stages of your investment and put them in your risk register. And what we say right here, there is reward. There is reward for the risks. And you will need to cope up with the risk for the future. For those organizations that don't identify the role of risks, they will need to get a total loss. So what you will see, if risk or the danger happen, you will see your organization have capacity to be rewarded with the insurance company. So there is a reward for the success. But here, there is a probability of failure. That's why we have to get the reward. We will get the reward because there are probability. Now, if you don't have mitigation, how your organization is going to cope up with risks, how is your organization going to cope up with risks is going to be a problem. And therefore, check if the events happen and you collapse, what is the impact of failure? So the impact of failure will be very high, of which will bring about the probability of failure. You know it exactly. Even if when you take a bus from Arusha to Dar es Salaam, or Dar es Salaam to Arusha, or Dar es Salaam to Mwanza, and so on, there are probability of car breakdown. There are probability of accidents. Have you insured your cars? If you cannot insure, if it happen, you get a total loss and you'll be responsible to the court and so on. But if you insure, you minimize the risks. So you have to say this. The impact itself multiplied by probability, this will give you the risks exposure. The risks exposure. The impact multiplied by probability, this will give you the risks exposure. And therefore, if you know the time to which your company is operating, it is what are the nature of activities of your organization or your investments. What is the nature of your investments? Is your investments, is it mining, or is it academic institution, or is it road constructions, or is it about hotel, or is it about lodge, or is it about bed and breakfast, B&B, or is about tourism investments, and so on. So depending on that investment, you know, even if you are taking tourists from one point to another point, when the events happen, what will be the consequences? If the accidents with your tourists happen, what will be the consequences? So you will need to be responsible. So it is important to sum of the risks. First of all, it is important for you to measure the impact and determine the probability of occurrence, and you get the risk exposure, of which at the end of the day, if you have insured some of these, you'll get reward. You'll be rewarded. You'll be rewarded. And that is good for the manager. It is good for the manager. And so any manager who's running any investments, you can insure depending on the probability of occurrence. Of course, not everything you can insure. There are some events that may happen. There's others are by nature. You have floods happening. You have to cope with it. You have a tsunami coming in, and you have to cope. You have to cope with it. You have you might be having the earthquake, like the one that happened in the Philippines And another one that happened very recently in Venezuela. Is it Venezuela? I think it is about somewhere in Venezuela. I can't remember exactly, but it happened some 2 days ago. It happened. So some buildings collapsed, very serious, and the people died. So what is happening is those are risks that you have to go with. You cannot avoid earthquake, unless otherwise you cannot control earthquake. So, but for other risks, you can mitigate. You can financial risks, contractual risks, environmental risks, some other issues you may control within your investments, and you get reward. So we ask ourselves, can we manage all risks in our investments? No, it's not. We cannot control. But managers cannot eliminate all risks in the investments, and therefore some of the risk factors are beyond your control. You have to go with it, and that is the point that we will need to look at it. And with us in here, you will need to identify. When you are making analysis about risks, you will need to know the work breakdown structure of your investments, and also you identify risks. You brainstorm. This is brainstorming the risks, and you assess. You assess the risks. You after identifying, you assess, you determine the probability of occurrence, and also you rank in terms of medium, low, and so on, and you assess in terms of the probability of impact. But again, what we need in every organization, we need to have a risk register. That is very important for our organization, and therefore once we should be updating from time to time. This will be the tool for us to examine about our risk analysis in our organization, and that is the point. So when it comes to response, we may find ourselves, we can have the response plan. We can eliminate some of the risks. We can avoid. You can avoid some of the risks. We may avoid. So as a manager, you will have to avoid some of the risks, and others you have to mitigate. You see, other risks you may transfer. You see, you transfer to third party. You transfer to another person. You can transfer through the insurance and so on. Other risks you have to accept. You see, those are the risk response for your investment. As a manager, you need to know exactly that this risk, we can go with it. We cannot avoid. This one we can avoid. This one we can mitigate. This one we can transfer. We can accept. Another one we can absorb. Another one is we can conduct research about it. It is for lesson learned on how we can respond ourselves. And those are the points that I wanted to make it clear with you. And you guys, are we together? Are we together?
Yes, doctor.
Okay. Yes, thank you very much. Very much. Thank you very much. Okay. Well, let me see. What time is it? Is it time? Should we continue or we do it next week? Are you ready?
Do it next week, doctor.
Next week, doctor.
But when I ask you, speak, you don't speak. But now you are talking. Grace, you are now talking.
Yes,
Okay. Okay, guys, because Grace has spoken. She has spoken. So we take this opportunity to say, enjoy your time and have a nice weekend. Next week, I think next week we shall try to be finalizing our discussion. So, Grace, the chairperson, who is the chairperson?
Agnes.
Hey,
Yes,
chap.
doctor. Yes, doctor.
Yes, yes. Please collect those individual assignment. They should be only submitted once they are written in Word documents. They
Yes,
must be
doctor.
written in Word document, not PDF, okay? So they
Yes,
should
doctor.
submit to you with their specific names, and in each, every person will have his own name, and again, submit it to you. You will give me the folder.
Okay, doctor.
Yes, Ashim.
Oh, yes, doctor.
Yes, before we go, you have a question, right?
Yes, of course.
Yeah.
I just want to bother to take me or to take us through in case of there is one tool in or technique to choose an investment to invest. It's known as equivalent annual cost. So please, can you
Annual cost in terms of what?
when you are selecting an investment, an
When you are
opportunity,
selecting,
an opportunity to
when you are selecting
yeah,
investments, we
yes,
have said right here,
yeah,
for mutual exclusive,
exactly,
mutual, 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 exclusive,
yes, investment,
exclusive, exclusive investments.
yes,
Investment. What we have said right here is very simple. We drew something like this. It was what? Right here, we said these are years, years, years. Okay. And this is investment A, and this is investment B. Now, this is year 0, this year 1, this is year 2, this is year 3, etc., etc. But again, we have IRR, and then we have
NPV.
NPV. And if I can remember the figure, right here, let's say it is 10,000. This is one example.
Yes,
And this is the example. I'm just drawing it from my head. And this is at year 0. And this is, of course, once it is written like that, it means it is the initial what?
invest.
Initial investments. And therefore, if that's the case, what we'll have maybe here is 350, and maybe here it is 600 and 600, maybe here 800. For example, I'm not computing, but I may be computing. I can compute the NPV for this one, but right here it is maybe it is 2,500. 2,500. Okay, and for this one is This is 25%, for example. And this one is 700, and this one is maybe 1,000, and maybe this one is 5,000, and the internal rate of return right here might be 40%.
Yeah.
Okay?
Yes, doctor.
40%. Now, if that's the case, what is happening is, for example, here it is 1,000. Maybe it is 1,500. 1,500. Oh, sorry. Here it should be. It
40%.
should be 40%.
Yes.
40%. So, what we are saying, we have concluded by saying, by using NPV, it can be a true indicator for mutually exclusive investments. Because when you look at the NPV at 25%, it has given us NPV of 2,500. And therefore, when it comes to setting priority, we will go to that investment rather than going into a small investment of that will generate 1,500 as NPV. This would have a lower NPV. So we can use it for mutual exclusive investments, but given the factors. Other factors that we can give is to look at the resources, the type of investments, because some projects resources are within your limit. And therefore, it is important for you to prioritize it is within your limit. There are some other projects you wish you could do it, but it is beyond your limit. So there are factors for selecting. And we also said the issue of markets, you see, we have said you need to look at market carefully and the time and other risks associated investments. We have already said that one. So we said NPV, you're not limited to use, but NPV can be the best strategy to select mutual exclusive investment for those projects that they have competing demands. Are you with me? Yes,
Yes,
that's what we said. Thank you very much. Hashim.
Yes, doctor.
Yes.
Yes, I get you when it comes to the issues of NPV and whatever the case, but there is somewhere I was reading a few days ago, and there is other method they just suggest it was known as equivalent annual cost. So I didn't get. Yes, that is what I was.
Okay. We will see next week. We will see. We will see. If there are so many methods, you are not limited to it. But this is the basic one that you may use. Apart from that, these are basic one because what I said, there are so many methods that you may apply to make selection with regards to investments. Are you with me?
Yes,
So NPV becomes the best. Okay? It supersedes the internal rate of return. You are not restricted because there are factors. There are factors you need to look at it. Which factor? I have already mentioned those factors.
Yes.
So you will have to check it by yourself as a manager. But just by advising you, because NPV is very much related to the industry, it's very closer to the industry, and majority of people use this one. They have advised. that when it comes to mutual exclusive investments, decision, use NPV. So that is the best. Very right. Yeah.
Okay. Thank you, Doctor.
Thank you. I appreciate so much.
Okay.
Ashim. Oh, another person? Another person. Okay. So for us, we stop right here. And when we meet next time, we will talk of, we'll continue talking about risks, but again, we will talk about risks, expected returns in terms of risks, the weighted average, and also expected risks premium. Those will be, and how do we compute? But again, I will bring some more example with regards to mutual exclusive investments. So that we should be able to play around with banks and the other financial institutions. Folks, just in brief, we have a lot of money in Tanzania. The money is sitting idle, waiting for investors. So you must be aggressive to grab those potential, grab them. So if you have your organization, it should grab those opportunities and make sure they create, take 5 billion, 2 billion, 20 billion, 40 billion, and so on. These should be your languages as a manager. As a manager, that should be your language at your level, and you can operate and sustain the country. But if we borrow 10 million, that is not, we are not serious in this world. We are not serious in this world. You borrow 50 million, you borrow 100 million, we are not serious. No, borrow a huge amount of money that will sustain the business and make sure that you are capable of employing others, but again, you add to the national growth and the development of the country. And this is very serious. It's very serious to managers. From now towards on, specify yourself. Are you risk averse manager? Or you are risk taker? Okay? Now, if you are risk averse, you will fear. You will go nowhere. You cannot be a manager. We need manager. I wish for those people who would borrow 2-3 billion, you can make arguments. You can make arguments that I borrowed the 2 billion from financial institutions, given this concept that I have at hand, and therefore we can say you are competent. You are a competent person. We can reward you. We can reward you. And rather than getting your certificates without trying to borrow the money from financial institutions. So everybody should borrow. And grace you should borrow. Amido, you should make sure you borrow. And everybody should borrow money. So if we borrow, our economy will grow. If we don't borrow, all of us, we are busy with the TikTok, and we are busy in the social media and so on, from morning to evening. Liverpool and Manchester and so on is a problem. It's a very serious, and it is a disaster to Africa. Thank you. I wish you the best and enjoy your time. Have a nice day. Bye.
Thank you, Doctor.
Thank you, Doctor.
Okay, bye.
Thank you, Doctor.